This has become significantly more accessible now because of something called Regulation CF, called Regulation Crowdfunding, because it allows non-accredited investors, aka regular people, to invest as little as like $100 into startup companies. Now, personally, over the last couple of years, I started doing a lot more of this type of startup investing in these types of startups because it's fun, it's something that I like. I like working with entrepreneurs, and I like investing in some of these smaller companies because a lot of people don't know about them, and you can see a lot of growth in these companies, but it also comes with the highest risk because these are smaller companies. A lot more of these companies will go bust. I mean, you can look at the statistics, 9 out of 10 startups or something like that go bankrupt. So many of these startups will fail. So you have to understand that there's more risk associated, but the possibility is if you can hit a company, invest in the company before it makes it big, you can also see much bigger returns. There's 3 main platforms that allow you to do this: WeFunder, Start Engine, and Republic. Now, I'm not paid by any of these companies to talk about them. However, I am an investor in the WeFunder company itself. But you can try it out. Look at some of the companies. If you like it, you can potentially invest as little as $100, but just understand the risk, because the only way you get paid is if the company that you invest in ultimately goes public or gets acquired by another company. So it's not a liquid investment. You can't just sell your stake in these companies whenever you want, and you're not going to get paid until this company gets bought out or goes public. So it could be years before you see another penny. The third way that you can consider investing $5,000 is by investing your money in real estate. Now, with $5,000, you're not going to be able to go out and buy a whole property yourself, but you can get indirect exposure to real estate, and there's a couple of different ways that you could do that. One way is through REITs, R-E-I-T, and the other is crowd-funded real estate. So let me talk about both. A REIT is a real estate investment trust, and this is something that you can buy and sell on the stock market. So when you invest in a REIT, what you're doing is you're investing your money into a company that invests in real estate. So it's indirect exposure because a company is going out and they're investing in apartment complexes or hospital buildings or office buildings, and then you can go and invest in the company that's buying these companies. Now, personally, I'm not a huge fan of REITs. I like more direct exposure to real estate because now you're also investing in the company. So how good is this company managed? How good is the executives in the company? How good is the whole structure of the company? So you have that potential risk, but you can also see more reward here because you get your dividends very consistently with these companies. But for me personally, I'm not a huge fan of REITs, but some people have seen a lot of success with them. The alternative would be to invest your money into crowdfunded real estate. So this is where now you're investing your money into a fund that's giving you exposure to a property. Some of these funds will give you actual direct ownership into a property. Other funds will give you indirect exposure to a property or a portfolio of properties. So it depends on which crowdfunding platform that you use. But now what you can do is you can invest in some cases as little as $10. Other crowdfunding platforms will require you to invest more, whether it be $1,000, maybe $5,000. Some even require $100,000. So it depends on which fund or crowdfunding platform that you're using. But now you can get either indirect or direct exposure to a property. Now with this, you will get your share of rent and you'll get your share of appreciation. The nice part about this is you don't have to worry about doing any of the management work. You don't got to worry about cleaning toilets. You don't got to worry about finding tenants. You don't got to worry about doing any of that. You have the investor, the developer. These are the main people that are putting together the deal, and they're working to grow the deal and ideally sell it or refinance it. That way they can give you all of your money back plus some. And then you're just investing your money hoping that the fund will perform well. Now, of course, there's risks associated with this because if the real estate market falls, well, then you might not see your money back for a longer period of time because they won't be able to sell or refinance as quickly. So you have risks associated with this, just like how you would have risks associated with you going out and buying a whole piece of real estate yourself. But it's a way to diversify your portfolio so you're not just investing your money into stocks or companies. The fourth place where you can invest your money is by investing your money into cryptocurrency. Now, out of the things that I'm going to be talking about, the 5.5 items, this is going to be the most speculative. So if you're going to be investing your money in cryptocurrency, you have to understand that there is risks associated with this because cryptocurrency is the newest asset class, and so it comes with the highest risk. Now, typically, when you invest your money, you want to have kind of a portfolio where you have different asset classes. If you want real diversification in your portfolio, then you would have different asset classes. And this is where a lot of people make a mistake because they assume, oh, I'm diversified because I have my money invested in a blue chip fund and a growth fund and a healthcare fund and a consumer staples fund. And these are all funds on the stock market, whether the ETFs or index funds, it doesn't matter. But the reality is all of your money is invested in one asset class. paper assets, the stock market. So you have no real diversification because if the stock market crashes, your entire portfolio goes down. So in addition to having some diversification in the stock market, you can also have diversification between asset classes. So this is where you can have things, I'm going to just draw these out like this. You can have things like real estate. You can have things like stocks. You can have things like other commodities. Now, these percentages are going to change. Like you don't want to have a huge percentage of commodities in your portfolio unless you think the world is ending, essentially. This would be things like physical gold. Gold doesn't really produce much value because it just sits there and looks back at you, but it's an insurance piece. So, you got to decide how big or how important is that insurance to you. For me, the biggest part of my portfolio is my business and my businesses. The second biggest piece of my portfolio is real estate. The third biggest piece of my portfolio are my stocks that I invest in. These are the things that I actively invest in and that I've passively invested in. The fourth is cryptocurrency. And then the fifth is physical gold. So crypto and gold are the smallest parts of my investment portfolio. And so you have to first create this type of portfolio here and understand how much risk you're willing to take, because cryptocurrency is going to come with the highest risk. And then if you are investing your money in cryptocurrency, you got to first believe in it, because you're going to have to go through a lot of swings up and down. So you want to make sure that you actually have faith in what it is that you're investing in, because if you don't, then when your investment gets cut in half, you're going to be one of the people that panics and sells because you didn't know what you're investing in, and now you don't believe in it anymore because the price has fallen. I invest in cryptocurrency the same way that I invest my money in stocks, where I have a daily dollar cost average system. Now, instead of investing my money weekly, because cryptocurrency is so much more volatile, I invest my money daily. So every single day, I buy a little bit of Bitcoin, I buy a little bit of Ethereum, and I buy a little bit of some of the smaller coins, and I just let my investments do its thing. I'm not sitting here trying to sell it in the next 6 months. I'm not sitting here trying to sell it in the next 5 years. I'm trying to hold on to this for the long term. Now again, is it risky? Absolutely. But again, whether the market goes up or down, it doesn't matter. I'm just buying a little bit more every single day. So if you believe in cryptocurrency, you believe in the technology, you believe in what blockchain can do, then you can consider investing your money here. But again, you might want to consider doing some sort of dollar cost average, because it's going to be impossible to predict when you're at a bottom. It's going to be impossible to predict how high something is going to go, how low something is going to go. So instead of trying to predict when the best entry point is, you can just dollar cost average your way in. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.